Hello everyone. I'm really thrilled that a record number of you can join us for our annual look at the Compeer Salaries survey. I'm sure most of you already know this, but Compeer is our sister company and part of the larger Parkwell group. The survey is a fascinating insight into the current state of remuneration across the wealth management sector, collected from over 10,000 individuals, all working within the industry. I'm pleased to say that once again, James Brown of Compeer will be joining us to talk through the results of this year's survey. Given the current state of change, not just within the wealth management industry, but across the workplace as a whole, we also thought it would be worthwhile looking again at how companies are coping with the hybrid working model, staff returning to the office, and the changing shape of work as we begin to see restrictions ease. Prash Arora, a senior consultant here at Parkwell, has put together some very interesting research from over 25 firms alongside his own thoughts, and he will be giving us a presentation after James. Lastly, I will be hosting a panel in which we will be looking at what to do about staff who perhaps do not want to return to the office, as well as best practices for recruiting, salaries, and hopefully much, much more. Melanie Stancliffe, partner at the employment team at Cripps Pemberton Greenish, has very kindly agreed to come and give us her legal perspective on some of those topics alongside James Brown of Compeer. And I'm pleased to say that we will also be joined by a new face here at Parkwell. Hugo Hunt is a highly experienced senior consultant with over 20 years experience working in both asset and wealth management, and has recently joined us to help grow our business. I'm looking forward to hearing some of his thoughts on salaries and recruitment. So let us get this underway. And I would firstly like to introduce James Brown of Compeer. Over to you, James.
Well, thank you very much, Dan, and good afternoon, everyone. And it's great to have this opportunity to share with you today some of the high-level trends that we've seen from our most recent surveys. And in particular, I wanted to focus on how the remuneration packages have changed since the COVID-19 outbreak, and also what firms are currently discussing. Therefore, many of my comparisons that I'll share with you are from our most recent survey, so that's the May 2021 survey, and how this then stacks up against the 2019 figures. Obviously, a year which seems so long ago, given the radical changes that have happened since then. So if we can move on to my first slide, please. Well, to start, I just wanted to give a brief introduction to our remuneration survey. And the main survey is run biannually, so we collect data as at the end of May and as at the end of November to always ensure that we're providing the most up-to-date information as possible. But I must state it is an all-year-round service, so we run multiple ad hoc surveys throughout the year for each of our participants. And a key differentiator between our surveys and others is that we solely focus on the UK wealth management industry, and so there's no risk of any skewing from other businesses in financial services, such as the investment banks. So therefore, all firms that take part can be assured that they are being directly compared to their true competitors. And we cover roles across the entire business, so there's over 110 positions being covered from front, middle and back office, and also some key director roles. And consistently we have over 40 firms taking part, and there's absolutely no restriction in terms of size, so it ranges from some with sub 1 billion of assets to some firms with well over 30 billion. So I mean, after all, recruiting staff and potentially losing them, it could be to any of these firms, and they are, after all, they are competitors. And in the latest survey, so that's the May 2021, we had 11,139 individuals included. So this has been steadily increasing over the years, and is now approaching a third of the industry. If we can move on to the next slide, please. Well, before I dive into the remuneration data, I just wanted to set the scene by using some information collected from our annual benchmarking survey. Now, many industries have suffered throughout the pandemic as they struggled to adjust to new working conditions, or in some cases, they actually entirely lost access to their clientele overnight. However, the UK wealth management industry has performed remarkably well, and it's actually set the benchmark for other industries. So taking the first figure at the top of this slide, so despite a collapse in the market in Q1 of 2020, where well over 100 billion was lost from the industry, both the firms and markets bounced back extremely quickly. And so by the end of the third quarter, all of those lost assets and more had been recovered. and then with further growth in the final quarter, it meant it finished the year at a record level of £1.15 trillion of investment assets. And I'm delighted to say that this trend has continued into 2021. And so the figure as at the end of June this year is now at 1.25 trillion. So naturally, higher asset values translates to growth in investment management fees. But really, the main story on the revenue side of things is that because of the extreme market volatility, trade volumes have absolutely surged. As a result, there's been a sharp pickup in commissions. So that rise in commissions has compensated for any reductions in other income streams, such as net interest income, which was declining on the back of interest rates remaining low. And so as such, total revenues finished at a record level of £7.65 billion. And then with the growth in business, the industry continued to recruit. So as at the end of 2020, the total number of staff equaled 37,660. So that was a rise of 853 on the previous year. So this therefore puts some of the remuneration results that I'm going to share with you into context. So it's far from the doom and gloom that many predicted at the start of the pandemic when the UK was in economic turmoil. The industry has performed very well, and as such, the remuneration packages remain very competitive. Next slide, please. Now, just one last slide before I move on to the actual remuneration data. And this is just showing the key departments which have seen the largest growth in staff numbers, and so were focal points for recruitment during 2020. And the first two departments I wanted to point out were the investment managers. So this is a combination of those individuals running the in-house funds, as well as portfolio managers that both manage the client relationship and the underlying assets. And the other group is the sales staff. So these are focused on selling wealth management services to intermediaries. Both are key front office roles, and it shows how confident the firms are of actually achieving future growth, with many of them expanding these teams to drive the new business going forward. Then moving on to the back office, we've seen a sharp rise in the number of operations staff. So one reason for this could be the surge in trading as a result of the market volatility, and such people in, for example, settlement positions may have been recruited to take on this extra workload. Compliance teams has been a continuing trend to expand, and I predict that this is going to continue in this manner, because rarely do we have a moment where there isn't an onslaught of regulations just over the horizon. And then the other two departments to record the largest growth were HR and finance, and both of which naturally expand when businesses grow in terms of total assets and total staffs. So let's now move on to the remuneration data on the next slide, please. And I'll start by looking at London-based roles. And so in our survey, we've got 104 positions in which we have at least 10 individuals in that role that are based in London. And here it's a comparison of the 2021 results against the pre-COVID results in 2019, showing the proportion of roles in which the median basic salary and the median total package either increased, decreased, or stayed the same. And I should mention at this point that by total package, here it's the sum of basic salary, bonuses, car allowances, and LTIP, so it doesn't include any pension contributions. And for many firms, the first response to COVID was naturally to freeze pay due to the uncertainty surrounding the industry. However, what these figures then show is since then, the pay has started to increase again. And in fact, across 78% of roles, basic salaries have increased during this period. And these increases are typically between 2 and 5%. And also shows that although staff were primarily working from home, actually their pay was very little affected. Most of them stayed on their pre-existing rates. And during the period, bonuses remained largely flat. And so the rise in basic salary was the key driver between any increases in total package. But one thing that must be taken into note is that 2019 was in fact a record year for staff costs. And so the fact that the bonuses have been maintained, it reflects how well the firms have performed during the pandemic to be able to afford these high packages. And if we can now move on to the next slide, I'll show you some of the UK regions data. And results, this time is from 78 roles in which we had at least 10 individuals based in the UK regions. And they're quite similar to the London results by way of the majority of roles reported an increase in basic salary. But these increases, or the increased percentage, is slightly less than we saw in London, and also the absolute amounts a bit less, where the median increase in basic salary for the regions was at 1% compared to the 2% for the London. Also in the regions, there's been a small decrease in bonus payments, meaning that there's more of an even split between the number of roles which report an increase compared to those which reported a decrease in total package. But still, I'd say these are very encouraging results given the disruption that the pandemic caused. And also, many of these staff may well still be better off as they'll be saving on other costs, or living costs, for example, on the cost of commuting. Next slide, please. So with the London staff largely maintaining their pay packages, or even actually boosting them in some respects, the London weighting very much remains. So for both basic salary and total package, a London-based employee can expect to receive approximately 30% more than the equivalent role in the regions. And for those that have already returned or are returning to the office, this is likely to remain the case for the foreseeable future. However, some firms have mentioned to me that they are reviewing their remuneration packages for those that are choosing to work entirely from home and potentially are basing themselves in the regions, for example, at a lower cost of living. And so for those that have regional branches, it's likely that they're going to have to ring fence packages so those in the same role, based in the same regions, will be on the same pay rather than the previous London-based employees keeping their London wage. And this is just one of the many headaches that HR teams are currently facing, as firms are looking to be flexible as possible in terms of the working arrangements. But obviously, they have to stay fair amongst their workforce. Next slide, please. So being a webinar on remuneration, I thought it's only fair that I share some live data on the latest packages offered by firms. And so, as in previous presentations, I thought I'd give you an update on the median packages offered for some key front office roles. So the top 5 roles in this table relate to various levels of portfolio managers. So these are responsible for both maintaining the client relationship and also managing the underlying assets. And the levels range from level 5, which is someone who's recently qualified, just started to build their book of clients, and will be generating revenues up to 300,000. Then you go up to level 1, they'll be managing in excess of £200 million, generating revenue of over 1.6 million, in many cases well over this mark, and also will often have management responsibility. So here you can see that most of these have total packages in 6 figures, and with the large pay packets for those top performers, the level 1 and level 2 roles, where packages often on a total package side will exceed 250,000. And these are median figures. So if you was to show the upper quartile, for example, for a level 1 portfolio manager and London based, you'd have to be paying in excess of 500,000 to attract these staff. And the next thing of note is that the relatively small difference between the London and the regional data. So it's more that the London weighting applies more on a basic salary for these front office roles, because they tend to have a much more formulaic element to their bonuses. And so these are heavily influenced by individual performance. And so therefore location becomes less relevant. And it's a trend we've consistently seen over the years. So as the productivity of staff improves, so does the pay packages that the front office receives. That's one reason why wealth management firms have often struggled in terms of scalability, because their costs are rising at a similar or even faster rate than their revenues. Now, the final 5 positions in this table all relate to financial planning services, and wealth management firms very much are continuing to expand their planning capabilities. And so these figures are very much a guideline to the packages that the sort of staff in these roles can be demanding. And for many of the top planners, they're again going to be expecting 6 figures. And as financial planning becomes an increasingly core service, I would not be surprised if the top performing financial planners would start to be looking to get levels similar to those of maybe a level 3 portfolio manager. Next slide, please. So we now move on to the bonus payments and how these vary by department. So in the yellow boxes, you have the average bonus percentage. So that's as a percentage of basic salary. And that's for all individuals within the roles within each department. I should also state that these have been calculated excluding those that didn't receive a bonus. And then in the green boxes, we've got the proportion of staff in each department that received a cash bonus. And so, for example, in the front office, you have just over 4 out of 5 individuals getting paid a bonus. And of those that did, it averaged 57% of their basic salary. And with the rise in basic salaries and static bonuses, naturally the bonus percentages are slightly down on previous years. However, as stated, across most departments, the actual total take home with the rise in basic salary is very similar to pre-pandemic levels. And encouragingly, across all departments, more than 75% received a bonus, although the value of these bonuses vary very much significantly. The front office dominate the staff wage bill, and with the high basic salaries and by far the largest bonus, both in absolute and in percentage terms, these staff are therefore the main influencers on a wealth management firm's costs, and even more so than other corporate, for example, which has roles which oversee the entire business, such as the chief executive officer. And as you then move into the back office roles, you see a significant decline in bonus values. And interestingly, IT staff are now at the bottom of the pack in terms of bonus as a percentage of basic salary. But I must state that this doesn't mean that they are the lowest paid, rather more that their bonuses relative to their basic pay is the lowest. So in a time when firms are embracing digital and other technological advancements, it seems like the staff responsible for example, maintaining the new software tend to be more on a fixed rate with a low rate of variable pay. And if we could move on to my last slide, please. And so to finish my presentation, I just wanted to share with you some of the ad hoc surveys that we've run in the past 12 months to give you a bit of awareness of what firms are currently considering and what they're discussing. Now, unsurprisingly, at the top of the agenda is the flexible or the hybrid working arrangements, and whether firms are adjusting pay for those not wishing to return to the office. As it stands, almost all firms currently are operating on the pre-COVID levels, and so have not made the adjustments, but some are certainly looking into this. And in terms of the hybrid working policies, they are now very common across wealth management firms, and the most popular setup today is to have 3 days in the office and 2 days working from home. And when reviewing the work from home arrangements and how the firm supported the staff, almost all of these firms in the past 12 to 18 months have provided some form of office equipment. And just under half of them I spoke to actually provided a stipend, with values ranging from £80 per employee to £500 per employee to purchase home office equipment. And what firms offer in terms of retirement gift policies has also come up. And very few have a formal policy in place, but I mean, not too surprising to hear that most have more informal setup or putting together collections and therefore offering a leaving party, maybe leaving drinks of some kind. And the final one I refer to on this slide is how firms are structuring their planning teams and showing an increased focus on financial planning services. And for most, the financial planners will be in a team setup where they'll be based on either on location or an area of expertise. Each team will then be assigned a specific paraplanner or paraplanners. And then beyond this, there's a more centralized admin team which provides support to all of the financial planning teams. And so that brings me to the end of my presentation. Obviously, we've got a huge amount of data behind this and beyond this. So if you ever would like to discuss the survey in greater detail or access more of this data, I'll be more than happy to have conversations with you. But at this point, I'll pass you back to Dan. Thank you for listening.
Thank you so much, James. I think every year when we do this, I'm staggered by the amount of detail you manage to come up with. And yes, it really is fascinating. And I think, as James mentioned, there is a lot of detail there. And with that in mind, we will be sending you all these slides probably next week for those of you that wish to dig a bit more into some of that detail. So thanks again, James, and we look forward to speaking to you again in the panel. Next up, we're going over to my colleague Prash Arora, who, as I said, has been conducting some research and come up with some really interesting conclusions. So over to you, Prash.
Thank you, Dan, and good afternoon, everyone. Following on from that great presentation from James, as Dan mentioned, I'll be looking at the results of some research we carried out with wealth managers on their thoughts on hybrid working and driving employee engagement. On my first slide, just quickly a brief introduction on myself. I have a number of years senior level search experience within wealth and asset management. Prior to that, I have a background in front office asset management, managing global equities. On my next slide, for those of you who are new to Parkwell, we are a management consultancy running change and transformation projects for clients with particular expertise in the private banking, wealth and asset management sectors. The recruitment arm has a strong track record, hiring key staff across all business functions in these sectors. On my next slide, please, let's have a look at some challenges businesses are facing at the moment. So as workplaces start to welcome staff back on a regular basis, business leaders really need to appreciate the balance between remote and office working that best engages their staff. Quite an emotive subject. And whilst the hybrid working model is widely considered as the way forward, maintaining employee engagement and increasing assets are ongoing challenges. But the pandemic certainly accelerated technological enhancements and productivity has mostly improved. It is the efficient delivery of this technology that is a constant challenge. The shift to a hybrid working model has meant the need for firms to re-evaluate the needs of their employees. And this has put an increased focus on well-being and mental health. On my next slide, the current situation, the past 18 months, as we all know, has been absolutely transformative for industry leaders. Unfamiliar circumstances due to the pandemic have been overcome. Issues around staff welfare has been an additional consideration for leaders. And the virus has changed the way leaders interact with their staff. But research also generally suggests that key concerns for employees are career advancement, communication, and maintaining that good work-life balance. And career advancement is of more importance to the younger workforce. So in research carried out by Parkwell, we spoke to the HR and business leaders of 20 wealth managers to discuss their thoughts on hybrid working and driving employee engagement. On my next slide, and despite initial concerns, the wealth management industry largely reported a relatively smooth transition to working from home. Initial issues with the technology and employees' ongoing interaction were swiftly overcome. All wealth managers surveyed have seen no decrease in productivity, with more than 15% reporting an increase. Most wealth managers have reported an increase in client engagement as well. All wealth managers have said that increasing assets has been very challenging, but most are getting plans back on track now. All wealth managers also implemented remote training and webinars for employees. Collaborative video meetings, online events, and communication hubs have all been hugely important in maintaining employee engagement, and this is set to continue. So on my next slide, from our conversations, wealth managers have expressed some concerns and things to be aware of. The industry has been built on strong personal relationships and face-to-face meetings. New forms of communication have led to an increase in engagement. It is maintaining efficiencies gained from flexible working, and that is an ongoing challenge. And one always needs to remember that company culture plays a crucial role in employee engagement and talent attraction. So to encourage this cultural change, wealth managers must ensure they provide the right level of training to support a cultural shift away from traditional practices and towards a digital future. Training programs need to be clear, structured, and accessible to all. A culture built on this continuous learning helps employee engagement and ultimately staff retention. On my next slide, a real concern for leaders is ensuring that there are not two tiers of employees. So it's therefore ensuring managers do not favour those that they see more often in the office. Firms are rethinking their performance processes, as well as how to assess talent and potential in a way that is much more objective and avoids the bias of working from one location versus another. It is hugely important that your tech agenda is central to your employee value proposition. And I'm afraid it is further workload for HR, as they need to work in close partnership with all stakeholders to ensure that the technology creates a basis of efficient working and is in line with company values. On my next slide, and looking at benefits, all firms have had to review their benefits over the past year to incorporate further aspects of well-being. By offering an attractive benefits package, employees are much more engaged in their work. And high levels of this engagement also correlate with other factors that characterize a strong employer brand, feeling proud about where you work and recommending the workplace to others. Low employee engagement significantly risks damaging the employer brand. And as well as an attractive benefits offering, leadership and effective communication are two factors that help increase employee engagement. Salary is adequate to retain staff, but it is much more cost effective if you combine it with an attractive benefits package. So on my next slide, I've taken a slight deep dive into some of the Compeer data to summarize some of James's findings. The data shows that basic pay has increased for the majority of firms compared to 2019. And when looking on a role-by-role basis, the upper quartile rise in basic pay is 5%. Now, this can be attributed to a couple of things. The industry has recruited more staff, especially within the front office, as James mentioned, plus 536 growth in investment managers. Assets grew in 2020, and this growth has continued into 2021. They have increased just under 9% in the 6 months to June this year, which will positively impact remuneration as it leads to revenue growth. Trade volumes have increased by 18% for wealth managers, caused by market volatility, and that probably explains the increase in operations staff, 282 net growth there. And as James mentioned, sales staff have increased, 151 net growth there, and that's probably caused by firms feeling more bullish about the future and seeing intermediaries as a key target market to achieve their growth. On my next slide, and on remuneration, most firms surveyed provided at least inflationary increases in basic salary during the pandemic. High levels of competition in the market have ensured firms have had to remain competitive to prevent key staff leaving. Although some predicted salaries to reduce with more people working from home, in reality, this has not happened. The rise in total packages, particularly in the front office, has a closer link to firm performance. The industry has had a record year for revenue and asset inflows have been high, both supporting strong bonus payments. Absolute profit has also increased. So for firms offering discretionary bonuses, this implies a larger pot to share around the business. High total packages have also been offered to keep key staff or win staff from competitor firms. And those firms looking to reduce or maintain levels of remuneration are unlikely to attract or retain the best people. So on my next slide, let's briefly have a look at a couple of YouGov surveys, one from last year and a few months ago, on the particular question of which benefits would make you consider changing employer if their offering was better than your current employer's offer. Last year, the three most popular benefits were bonus and profit sharing, flexible working, and pension scheme. As you can understand, this year, flexible working is now the benefit that most people are after. The survey also highlighted the fact that 9 out of 10 employees under the age of 30 would consider changing employers to receive better benefits. If you filter down further, healthcare benefits came out as less important for this age group, and they rank learning and development options as more important as they focus on career advancement. So that just highlights providing support towards qualifications and skills learning is very valuable and important to employee engagement, loyalty, and ultimately staff retention. On my final slide, please, to conclude. So the industry is very resilient, and following the pandemic, most firms have performed better than expected, and all firms report an increase in client engagement. We believe remuneration will be a key issue over the next 12 months. Firms need to ensure their staff are paid in line with the market in order to retain them. If firms wish to recruit, they must offer to pay salaries and bonuses in line or better than the market. Flexible working will be an attractive differentiator, and it is expected that many of the efficiencies and increased productivity will continue. We have all learned that you can still continue to operate effectively and still to continue to grow a business or change strategy in a hybrid working model. And flexible working also provides firms the opportunity to widen their candidate pool in terms of geographical reach and coverage. And to be honest, the pandemic is likely to have advanced the industry by a number of years, especially in terms of technology and client engagement. And finally, if you are agile and maintain efficiencies gained from the past 18 months, you will be well placed to continue growing. So that's it from me. I hope that has given you some insight on current industry views. Thank you for listening today, and back to Dan.
Brilliant. Thanks so much, Prash. Again, I mean, a great level of detail, so much in there, and I feel that there's probably stuff that I didn't quite realize. And again, that's why we'll be sending out those slides to you all as well. And like James, I think if there's anything you wanted to dig down into with Prash, he'd be very happy to speak to you about some of those things. And I think a lot of those topics that Prash brought up, we will now be taking forward into our panel discussion. As I mentioned at the start, I'm pleased to say that Melanie Stancliffe of Cripps, Pemberton, Greenish will be joining us for the panel. So perhaps the best way to get that started is for Melanie to tell us a little bit about herself, who she works for, her specialisms, etc. So over to you, Melanie.
Thanks, Dan. It's great to be with you. Thank you for having me again. I'm Melanie Stancliffe, and I've specialised in employment law for the last 25 years, spending 20 of those in the city. A lot of my clients are in the financial services space, and this is my bread and butter. So at the moment, 90% of what I'm dealing with are issues arising from contractual disputes and problems with hybrid working.
Brilliant. Thanks very much. I'm sure we will get into some interesting topics with you. Now over to Hugo Hunt, who has recently joined us here at Parkwell. Hugo, perhaps you could tell us a little bit about yourself.
Yeah, thanks, Dan. Well, I've been in the recruitment industry for going on for 25 plus years, seen a number of ups and downs, a number of changes in the market. But I think at the moment, this is a hugely exciting time, particularly in the wealth and investment management world. There's a lot of activity out there, very positive performance reports. And I think from my perspective, having recently joined Parkwell on the recruitment side, I've been absolutely fascinated by Compeer's work, what they do in the market, and having spoken to James and various other people within that team, just how effective I think Parkwell can be going forward, utilising some of the information that Prash has mentioned. So very much looking forward to sort of combining that data market research into our recruitment processes and taking that out to past and hopefully new clients as we develop things.
Brilliant. Thanks very much, Hugo. At this point, I suspect we all know who James Brown is and indeed what he does. So I don't think he needs to introduce himself. So why don't we head straight into the questions? I think the way we're going to do this is I'm going to ask a few specific questions to each individual member of the panel to get things going, and then I've got 3 or 4 things we can discuss perhaps all together afterwards. So in the first instance, I'd like to go to Melanie. And the question here we thought about was, how do we deal with people who perhaps don't wish to return to work, come in late, leave early, citing concerns about catching the virus on public transport, in the office, etc.? A lot of those obviously are very legitimate concerns, but I suspect they raise issues around hours, timings, etc., etc. And I just wondered what your thoughts were on that.
Well, I think the first thing is that there isn't a one-size-fits-all approach, but I've been tending to talk clients through a carrot and stick. So the carrot is that we express to our staff all the safety measures that we're doing, the sanitizers, the spacing, the one-way systems, and we're really communicating that the workplace is safe, having good conversations with staff members, making sure that there's an open dialogue. So if the concern is about the travel to work, perhaps having some flexibility built in where the employee does their working hours but comes in later, leaves a bit later, or vice versa. Also thinking about encouraging the vaccine. No employer can mandate it in this space. So we're trying to encourage staff to take care of themselves and their colleagues that way. And then, you know, the great oldies, you know, the quizzes, the pizzas, you know, the social events, all those things that incentivize people to come back. And if those sort of carrots don't prove effective, then you have to start putting the expectation down of when people will be returning and how often they need to be in the office. And a lot of this comes back to what their contractual arrangement is. So unless they've got in their contract that they have the right to work from home, which is very rare, you can remind them what their place of work is. And ultimately, you could take them through a disciplinary if they're not complying with the reasonable sanction to come back. There are a couple of exceptions. Obviously, there are some people for whom there will be travel issues. They cannot take a vaccine because of health or pregnancy related issues. And in those circumstances, advising employers to be sensible and be flexible is probably the best way to keep them from acting in a way that could be discrimination. But if an employee is saying, well, I cannot do this, then the employee has a choice. They have the option to resign. They have the option to put in a flexible working request. You know, or they have the option, if they can't work, to agree in hiatus, and then that has pay implications. So those are the things I've been thinking of.
Thank you. And can I just ask, you know, how much of your time now is being taken up with this kind of stuff? Is this becoming the everyday, or is this an unusual thing that people are concerned about their working hours?
No, I think it's very common. I mean, there are strands that go out from this. You know, people coming back from maternity leaves, from furloughs. What are we doing about staff that we perhaps can't accommodate because we haven't got that amount of work in that place or at that time? So there are lots of redundancy and other conversations that are going on at the moment. But I think a lot of what employers are dealing with is this sort of day-to-day and having to make sure that staff are safe, that they are being seen to be safe, having to do risk assessments, having to change policies, which I'm going to come on to a little bit later. You know, there is a lot, particularly for HR teams and ops, to be doing right now.
Yeah, brilliant. Thank you. And obviously, it's difficult times for a lot of people, and it's very understandable that they don't want to come back. But we do all need. Well, anyway, let's see. I suppose on that, the other thing we thought about was firms adopting a hybrid working model, some home, some office. What sort of impact will this have on their employee contracts, do you think? Or do you know?
Well, I think the first thing to say is that any agreement that somebody can work partially or wholly from home is probably going to be a change. So, you know, you have to document these sorts of things and make it clear what the arrangement is. And some people have done that informally, they've done it in emails, they've done it verbally, and you know, that's not the ideal way to do it. To make sure that you've got clarity on what the expectation is, you want to be putting these things in writing. And as James said earlier, you know, the follow on from this is employers starting to think about removing London waiting, starting to think about the allowances, the stipends, having a look at what is still payable. Now, the corollary to that is if a staff member's working from home, the issue becomes, you know, how much does the employer have to pay for the insurance, for the electric, you know, for all of those things. And the starting point there is that the employer doesn't have to pay a penny. So you're starting to go into negotiation territory with certainly your senior staff who are going to have the greater negotiating power to achieve payments for these sorts of things. And then if you're changing the location, you're perhaps changing hours, you need to be thinking through what that means in terms of when the employee is going to be available. And a lot of employers are starting to think beyond that hybrid and agile working guidance to beefing up their security arrangements, making sure that their confidentiality, their data protection, their monitoring, all of those things have to be put properly in place. In the office, obviously, an employee who is putting in a C drive and downloading a load of material or printing off the client list, those things are very visible. They're not as visible when somebody is working from home. So employers have got lots of other things that they need to be thinking about, the implications of somebody working from home. We're seeing the reworking of performance criteria. One of the hidden problems with remote working is, how do you manage a workforce that are perhaps present and working from home? How do you make sure equally you're distributing promotions and opportunities, and making sure that you are seen to be fair? Because we know that some employers have got to report on their gender pay gap and on their the pay gap between different ethnic minorities. So they have got to ensure that they are doing all of these sorts of revisions fairly. And as my colleague Rona Derbyshire was quoted in the Times today, there is another mental health consequence of staff not being present in the office. If somebody was in the office and turned up and looked very tearful and upset, you immediately, as an employer, one would hope somebody would raise the concern about their mental health. Equally, if someone comes in with a black eye, you're going to pick up, but you may not be able to look at those sort of mental health issues, people's isolation, potential for domestic violence, and a potential for them feeling quite depressed, ill, isolated if they're working remotely and online.
Okay, thanks very much. And there's a few very interesting points there I might pick up on a bit later, but perhaps just on the back of what we were talking about, the hybrid model there, I could come to you, James, and say, I just wonder if Compeer has had any data about the benefits to the hybrid working model, clients and or firms, whether you've seen anything there.
Sure. Well, I'm pretty sure you won't be surprised to hear we've got plenty of stats in that sort of area.
It sounds like you, James, have plenty of stats on anything.
And so, I mean, obviously already on the firm side of things, already shared the ones that they managed to generate record assets and record revenues during the pandemic, when they actually was 100% working from home. And just to add to some of those, I mean, on the inflows levels, so purely organic, 93 billion in 2020, and their previous record was only 97 billion. So they almost broke a record there. On the productivity side, Prash touched upon that most have seen an increase. If we focus purely on the front office productivity, some ratios like managed revenue per front office professional, that increased. So it went from an average of 459,000 to 471,000. The average managed assets per front office professional also increased from 72 million to 75 million. So on a firm level, they proved that they can certainly adapt and with work from home, maintain the levels, or if not even improve them. From the client side, I'd refer to our clients' view survey. So we run this on a yearly basis, talking to 500 affluent and high net worth investors who are actively using a wealth management firm or a private bank or an IFA. And so for some of those figures, they were asked whether or not they felt the value for money had improved during the pandemic. Actually, 50% felt it had improved, and only 10% felt it worsened, with 40% saying it stayed the same. So that's obviously a very encouraging result. And in terms of whether or not they were still on track to achieve their personal goals, 75% agreed with this. Then you've got 86% that said they would actually continue to recommend their advisor to their friends and family. So obviously, referrals are a key source of new business, and it looks like that's going to continue even with the current working arrangements. And just one final stat, one reason why their clients are so happy is communication levels. In fact, during the pandemic, they improved. And so 55% have had more communication than they had previously, and just 11% felt it had reduced. And so although it's more on a virtual basis, it's more frequent, the clients feel more in touch with their advisors, and it's no surprise, therefore, that they're very much pleased with the service they're currently receiving and would like it to continue.
Brilliant. That's very thorough. Thanks very much. And I might come to you now, Hugo, and sort of referencing there what James has said about some of the client satisfaction and inflowing incomes. I don't suppose it comes as a surprise to any of us to also see the rise in base salaries over the last 18 months. And I wondered what you had sort of thought about that and whether you'd advise clients on what to do when recruiting new staff in terms of base salaries and the rises that there seems to have been.
Yeah, I think definitely people have still got a level of expectation after the sort of very positive returns that have occurred, and in some cases quite difficult working circumstances. I think those people that have performed well going forward into next year's budgets and salary increases, performance bonuses, I think there are levels of expectation that those should probably exceed what has happened last year. Yeah. So having said that, there are a number of points around recruiting at the moment that I think are largely around the same theme, but all come together in terms of the softer side of things when you're recruiting and what a company can offer, but most importantly, how they look after their staff. And certainly one of the big issues that I'm hearing from people is they wish to feel a sense of belonging to an organisation that they're working for. And a lot of that revolves around, James mentioned it, around communication. And it's good to see a lot of senior managers, business leaders, spending a lot of time trying to communicate not just the sort of corporate story, the values and the ethos of a business, but also giving people an understanding of where the business is going, giving people a pat on the back for their successes, and actually, really meaning it, rather than it just being a token effort, actually really meaning it, giving people that sense of well-being, sense of being part of a larger family almost. And I've definitely seen that talking to less experienced middle management, junior management people. I think at a more senior level, there is far more that focus on salary, bonuses, etc. But at the more junior level, it's what can I actually attain in this role? Have I got a career within this organisation? Do I feel valued within this organisation? And when you're recruiting, it is actually very difficult to put that across succinctly. So I think my advice going forward for recruitment is for organisations to really get their corporate story well tied down and built into their recruitment process, so that you are demonstrating how, as an employee, there are going to be opportunities to develop your skill set, your career, that you are going to be listened to, that your ideas will be thought about. They may not all be acted on, but that there is an ear for you to put across your ideas and talk about your concerns and your issues. And that is, I suppose, from the outset, there is a need to clearly explain what is expected, right the way down to things like, the working from home. If you're 3 days a week in the office, that needs to be explained. It needs to be set out, and where there are, issues for an individual, they need to be explored properly. And certainly during the recruitment process, all of that can be put across clearly and provides, I think, a level of comfort to anybody who is going through the recruitment process. I think the other point, and when we look at I suppose almost a fight for talent in the market, I think people have to think slightly outside the box, and that's not just bringing people in from alternative backgrounds, maybe the investment management world, investment banking. It's also how you approach the recruitment market. I think the days of going into a newspaper, the Times, etc., and putting up an advert are pretty much gone. The advent of things like LinkedIn, all of that is changing the way people recruit. But just looking at relationships in the market, I think there's a need now for employers to very much engage closely with their recruiter, to spend a bit of time explaining the values of the business, because ultimately the recruiter is going out to the market as your representative, and therefore they have to understand what the culture is, what the benefits of working for a particular organisation look like. And certainly, within Parkwell, that's what we're trying to do. That sort of consultative approach, added value, and partnering with Compeer with the data that we've got. I think we can add value above and beyond just the recruitment process. So providing people with background information, company insights, and all of that is valuable to a prospective employer, because it enables them to gauge the market and to understand the temperature in the market and how people are feeling.
Brilliant. Thanks very much. When we speak about the difficulties and what's going to be happening, do you think that numbers of staff within the industry will continue to rise, Hugo?
Yeah, I think definitely. If you look at a situation, over the last 18 months, you've got a lot of young people who have entered the market, who have come into the wealth management environment, who have very quickly gained their qualifications. They've gone through their IMCs, they've gone through their CFAs, but in terms of actual practical experience, they're actually probably behind the curve for the 18 months that they've been employed. So hugely technically qualified, but in terms of a practical sense, somewhat behind, because they're not sitting next to and hearing and engaging in the day-to-day business scenario.
Yeah, it's very, very interesting, that whole kind of, and I suppose it's bringing me around perhaps to something that Melanie touched on before, and perhaps I could ask Melanie and you, Hugo, and certainly James, if you've any thoughts as well, I'd be interested to hear them. But sort of anecdotally, I think I'm sure we all have heard a few kind of stories about people who are in the office being in a better position to get hold of some new business or some training, even if it's ad hoc or just sort of over the water cooler. I know it sounds a bit of a cliche. I mean, I don't think any of us really want that to be happening. It doesn't sound meritocratic. It doesn't sound democratic. It doesn't sound like the way business should be done. But do you think that is an issue that could become an issue going forward? Melanie, I don't know what your thoughts are on that. You certainly mentioned it a little before.
I do, and I think it's one of the hidden problems. I think that there's two aspects of it. I think that team leaders, managers, senior people in the business have got to work harder to include everybody and to be seen to be being fair. So those corridor conversations that they would have had, if they have those with people in the office, they've got to make sure they have the virtual one-to-one, so that they're treating equally the people that are working more remotely. I think the other thing is for individuals who are working from home, or preponderance of their time is spent at home, they've got to make extra effort to be visible. And I think it's on all of us, wherever we are as team leaders or as the individuals being led, to play our parts. And I think one of the things that we're concerned about from the employment point of view is really how employees will feel if they are perceiving that they are not getting a fair crack at the whip, promotions, rewards, opportunities, and even those sort of learning experiences, going along to client meetings or attending client meetings virtually, you know, who you select for those things, you know, it's got to be a fair division of that sort of arrangement. Or some employees will appear slighted, and if they are of a particular protected characteristic, you know, that they can complain, and that could give rise to problems, and certainly concerns that the employer then has to deal with, which takes it away from its BAU and its purpose, which is to generate revenue. So it's trying to think in a longer term, how do we do this fairly, and how do we do it so we are seen to be fair?
Yeah, I mean, I wonder if there will become that kind of two-tier system almost, where, you know, is a face-to-face meeting going to become more valuable than an online meeting as time goes on? It's difficult to know. Hugo, I don't know if you had any thoughts on that kind of water cooler thing, whether you've seen anything about that.
Well, yeah, I mean, I totally agree with Melanie. But having, again, you know, just from conversations I've had in recent times, you know, there's no doubt that people favour, you know, I think it's largely human nature. People favour that human interaction, that face-to-face. You know, far easier to ask somebody's opinion when they're sitting 2 desks away from you than it is to pick up the phone or, you know, get a Teams call going. You know, it's that spur of the moment, largely. And those are the things that it's very difficult to avoid.
Yeah.
And so, like Melanie says, you know, it's a two-way street. You know, sitting in your office at home, you've got to make every effort to keep in touch with the guys in the office, and vice versa. Unfortunately, because of the way that you know, human interaction happens, and it being so much more easy to just look up and have a conversation, it would suggest that it will favour those that are sitting in the office. But
Yeah.
you know, I think it has to be worked on.
Yeah, I don't think it's something that we can allow really to happen. But well, that's great. Thank you very much. I think we're just about out of time now, and perhaps I'm just going to finish with something for Hugo and James. If I don't know, James, I don't know if you've got something for I've got. I'm just wondering what you think the most interesting change within the wealth management business is to have come out of the pandemic. I don't know if you've got a stat or something for that, but.
Well, I won't put an exact stat in it, but more for me, obviously the change in working culture has been massive, and it's been fascinating. And I applaud all the wealth management firms for delivering the level of performance they have during the pandemic. But for me, it's on the technology side, because I've been tracking the industry now for about 16 years, and rarely is there a step change in costs in any particular department. There's steady increases, and often when wealth management firms want to change, it's taken 3 to 5 years to implement it. But in the 2020 results, there was a huge step up in IT costs. And I think the pandemic certainly, or some firms were looking into it pre-pandemic, but the pandemic itself has acted as the catalyst. It's made them get the decisions quicker. And they're embracing digital services. The tech spend obviously has increased, and the sort of services that they're delivering to clients is now on a virtual basis, or like the portfolio valuations is much more advanced than it was 2 years ago. And they're obviously playing catch up. I think it's great, finally, that the wealth management has started to move much quicker in this area. So that, for me, is the most interesting change.
Brilliant. Thanks very much. And Hugo, I don't know if you had a thought on that.
Well, I suppose slightly tongue-in-cheek, what I've seen and been hearing is the change in people's memory. And a lot of people have forgotten what the old work environment was like, and a lot of people now are unaccepting of you know, returning to the office. And I've heard over the last day or two some cracking excuses why people have decided they're not coming into the office. One which included it was raining. You know, it's a strange world, and you know, it's one that I think is going to take a little bit of getting used to. Well,
I think we'd all probably agree with that, and I think with that, it's not quite raining. It looks like it might start, but we're just about, well, we are out of time. So I'd like to thank all members of the panel and Prash for your amazing contributions. I think it's been a really interesting, insightful session full of facts. So couldn't ask for more, really. Thank you all very much. It strikes me that the wealth management industry has travelled an awfully long way in 18 months. And I think everyone's to be applauded for some of the brilliant changes that have happened. But I suspect there's also a fairly long way to go, and in some areas, and we really want to make these changes for perhaps people who are coming up in the industry now or are starting recently, and make sure that this is a challenging, inventive, and exciting place for them to work. And it certainly sounds like we're doing that. I think the next few years are going to be very exciting indeed. So with that, thanks very much indeed, everyone. We're going to leave you with a slide detailing some of the other events we have upcoming. And I hope to see, well, certainly some, if not all of you at those. Thanks very much for joining us. Take care. Goodbye.